Well, good afternoon, everyone. Thank you for being here. It's actually really great to see all of you back together here in Monterey. I know I've been looking forward to that and to this dialogue. It's been some time. But as the capstone discussion here on the main stage before we end today's session, I couldn't help but frankly, talk about the most important topic on our minds. It was the most important thing that we've been thinking about as we all traveled here to Monterey. It's clearly the thing that's been threaded through all of our conversations today, and that is what do we do as CVCs in turbulent times? It's funny because Christina Riboldi and I were talking about the name for the session and even the topic, and we were debating, is it CVC and uncertainty, CVC and turbulent times? I think that's definitely the theme, and I mean, for what it's worth, I think we've all had thoughts about it. It's, that conversation really helped us kind of reflect and think about our own thoughts, having been in up and down markets for the past 3 decades at Touchdown Ventures as part of the team. But what I hope to do is to actually frame what our opportunity set is, perhaps a little bit differently, talk about what's changed, what hasn't changed, and offer some tools that you can take with you back home as you're running your CVC funds, as you're talking to your parent corporations, as you're talking with your co-investors, working with your portfolio companies, and considering what's next, some tools that you can use to actually take action. So if there's nothing else that you leave from today's session with, you'll leave with a lot of great thoughts from all of the prior speakers and some new ways to think about it and some new things to do. Hopefully. Okay. Well, I think many of us in this room have, as I mentioned, we've been in up and down markets before. I think Bill from Sequoia said earlier today, perhaps those of us who have been in some of these down markets before might have selectively forgotten because it was traumatic, or maybe we have a little bit of PTSD. For those who are relatively new to entrepreneurship or venture capital, corporate venture capital, you're probably learning a lot as we go through this. But I think some of the things we can think about are, frankly, what we're facing this time. I really liked what Nancy Fund from DBL Ventures had to say, where she said it's not just an economic downturn like we faced in the dot-com crash, like we faced in 2008, 2009. There's also these more existential threats around climate change, the pandemic, war, and other things that are driving things, which probably, for all of us, says, hey, this time is different. There's a lot of uncertainty. How can I possibly know what to do if I'm looking out at this brand new situation that doesn't look like these past downturns? Even if I was investing then, there are new dynamics at play, and there's just a lot more uncertainty out there. So how could I possibly know what to do in such a situation? I would say, conventional wisdom says in a time of uncertainty, it's time to pause, to assess all the factors, the multiplicity of point of view that we're hearing from inside of our corporations, from our customers in the market, from the startup companies in our portfolio and that we're speaking to, from our co-investors, of course. But actually, if you think about it, while there is a lot of uncertainty, there actually is just a few things that we need to focus on when we think about what to do. And we can actually flip the script. We can be bold, focus on those specific things, and move beyond. So let's think about that. In our experience, there's really only 2 factors to consider. All the other things that have been discussed today are important, but there's really only 2 factors that we should consider when we're thinking about how to act and what to do next. The first is cash. Mind you, we're coming off of a period of the record highs, the highest ever for any kind of capital invested in venture capital. You all know this, you've seen the numbers, no surprise to you. So this is on a relative basis, but cash has already and will continue to be a little bit more scarce, a little more uncertain, a little more pricey. And then institutional VCs. Some of you are in the room today. Most of you are CVCs. But institutional VCs are going to be watching and waiting to see what we do. Why? Well, those that have been around for some time, especially going back to the dot-com days, I was on the entrepreneurial side of the house then, but you saw most corporates fold tent, walk away from having a fund and from supporting portfolio companies. Obviously, we all know what that does to the other investors. It's bad reputationally, and it's hard to recover from, and that's why you still hear echoes of that today. So one of the things that we have to be thoughtful of is what is it that we're doing, not only for how we're treating our portfolio companies, but also what are we doing for the future? What we do today not only has an impact today, but does carry through, and it could have a very lasting effect for the next few decades. So being thoughtful about that and how we act and what we do, very, very important. So I think if we pause for a second and say, well, if this is what's changed, well, what hasn't changed is part of how we should act. We should continue to communicate early, often, and clearly with our co-investors, portfolio companies with corporates. We should be transparent and set expectations appropriately. Don't make big promises. Don't get people scared, but just be open and honest and be human, really, as we go through this. We should continue to look for opportunities for return for our corporate parent, of course, both strategically and financially. And most importantly, we should think about both our existing portfolio and new investments. And that's actually those 2 points I'm going to spend a little bit more time on here today before we close. And this is where some more of those actions will come into play. So going to the funds that already exist, that aren't brand new, bar none, if there's one thing that you do when you leave here today, it is really to prioritize the portfolio. There's a lot of noise. Focus on that, because at this moment, there's actually nothing more important than that. So how do you prioritize supporting your portfolio? Well, there's a few things to be aware of, but also a few things to do in this. If there's one thing that you think about when you're prioritizing the portfolio, it's just starting with a very fundamental thing, something we're all very familiar with, and that's cash. We have to understand and get a very good grip on how much cash do each of our portfolio companies have. What does that look like going forward? We have to, of course, be more conservative in both projecting revenues and managing that cash, and really fine-tune that, and work with our CEOs around that. And then really, figure out the plan. I think we heard from Bill from Sequoia and from other investors throughout the day that really taking a moment to think before you act is incredibly helpful. Startup CEOs, whether inexperienced or experienced, and us all, we tend to either overreact or underreact to a situation. Be thoughtful first. Communicate with the rest of your co-investors. Be in touch with with the chairperson of the board if you're not that person, and make sure that you have that part figured out. If once you have that, you can also think about, okay, well, what comes next? Of course, we're all now talking about if you can go beyond 18 months and you go to 24 months of cash, obviously that's an ideal situation. Well, how do you shore up the balance sheet? How do you shore up that cash position? Perhaps you're in a situation where you say you want to, with other insiders, support the company on an interim basis. You don't want to go to the market and face those valuations at this point, although that's not necessarily a bad strategy. We can talk about that. And that is, and that when you think about that, it's, effectively a bridge. The main thing to think about here is bridge, but don't peer. Bridge to something specific going forward. Have that plan and know where you're going to next, instead of ending on the pier and then falling off the cliff. That's very important. So you can sustain the valuations you have. Perhaps you take a markdown if you find that's most appropriate. As painful as down rounds can be, they're not necessarily the worst thing. I think if you kind of look around, we're going to be seeing a lot of that as companies raise their next round of capital. So as with anything else, be thoughtful. and think about that. It's not terrible, and companies can recover from it, potentially coming out stronger as well. So it's most important, of course, to be realistic when it comes to valuations. I think some of these other points were already covered. You've probably read them already. So moving on to new investments, we've heard it multiple times today, and here on the stage, out in the hallway. Now's a great time to invest. Whether you're a brand new CVC, it's actually a great time to start one. It's a great time to invest. It's actually a particularly favorable environment for corporations. If you actually pause for a moment, you can think that out of anyone who's deploying capital into the market today forward, corporations are arguably in the best position to do that. Why? Well, institutional VCs could face the denominator effect, where LPs pull back the capital that they had originally allocated in their own portfolios. If they were targeting 8 or 10% of their portfolio to be in venture or in private markets, and as the stock market goes down, they become overweight, and so they have to pull back. And so it's a simple math equation. And unfortunately, the VCs that are doing even better in this down market suffer the worst, because their outperformance balances against the down performance in the stock market, and it ends up being worse. So they face a situation we're not facing. While our corporate parents, their stock price may also be declining, we have cash on the balance sheet, and that's where our investments typically come from or are made out of. And so we don't have the same constraints. We have the ability to not only deploy that capital selectively and in the right way, we also have the ability to apply those other resources, all that great operational support, commercial relationships, and other things that we can do to help the new portfolio companies as well as the existing ones. So some other tips. I think now is the time to exercise and flex our muscles on the financial and operational and strategic due diligence. This is where we really shine. This is what we want to do all the time anyway. It's been very hard to do in the recent up market, where, of course, high valuations and speed to close have been the winning strategy. People are more patient, and they're willing and much more interested. Startup CEOs are much more receptive in this market, where it's not just growth at all costs, to work with corporates and really have that exchange of value that we've been here all along to do. I think the other final takeaway here from this page is really thinking about, so we're doing that kind of planning ahead, prioritizing those resilient business models, thinking about those that will thrive in the interim period as well as the long term, can also be super helpful. That goes for new investments. That also goes for the existing portfolio, where you might tweak or pivot to adapt to the new environment. So these are some thoughts. We have more thoughts on the topic. We've actually been writing all along about the best strategies in existing markets, in the up cycle as well as in down cycle, how to have longevity in your program. And actually, we're going to be continuing the conversation in a roundtable at 4:15 today downstairs in Cyprus. So I hope to see many of you there, so we can talk about what's happening in your corporate partners. In your corporate parents, and actually trade strategies on what to do next. Thank you so much.
All right, everyone. Well, welcome to the afternoon networking break. We hope you're enjoying the GCVI Summit. Just some housekeeping notes for you. For the slide deck,